Hi traders, in this video we're going to be looking at the golden cross. The golden cross is basically a crossover of two moving averages. We're looking for them to cross in an upward direction to signal the start of an uptrend. So the first thing we do is we put the moving averages onto the chart. So the golden cross, you have a 200 moving average and a 50 moving average. Okay, so you can see the moving averages there, and what we're looking for is for the shorter term moving average, in this case the 50 moving average, to cross above the longer term moving average, which is the 200 on the golden cross. So basically the 50 MA to cross the 200 MA will signal the golden cross in an upwards direction. And let's just have a look for when that happened on this euro dollar 1 hour chart. So that occurred here. Okay. Now if we zoom out, it's a bit too far. If we zoom out, we can see that, okay, this is quite a choppy market and perhaps not the best example. However, you don't necessarily have to take every single golden cross, but we can work with this one. So you don't necessarily need to enter as soon as the moving averages cross. In fact, that's probably not a great idea. I personally prefer to use other indicators and price action analysis to confirm the entry. I mean, you could, if you want, in theory, if you just entered on the cross here, this price point, and exited the trade on the opposite cross, well, you'd be lucky to break even. So this is why it's important to have specific entry and exit criteria in place, and I'll give you a few examples in this video of what you can use to time the entry and time the exit on a golden cross. And if we just scroll back, well, here's a better example perhaps. The golden cross here. Now if you look at this one, when the 50 crossed above the 200, it was a big upwards move, which if you just entered without any additional confirmation, just on the cross up and exited on the cross below, we would be looking around 150 pips, which is a really good trade for a very simple strategy that doesn't require hardly any time to spot it on the charts. This is a 1 hour chart. You can look at the golden cross on any chart time frame. I personally prefer the 1 hour charts and above because I find that the longer term time frames tend to give more reliable signals. Okay, so let's go back to the not so good example of a golden cross, just to show the importance of using additional filters to time your entry. Okay, so to filter trades on this golden cross here, I'm gonna use a stochastic oscillator. So if we just put that on the chart with the default periods, 533, simple, okay. So if you're not familiar with the stochastic oscillator, basically anything below this line here, the 20 line, is considered oversold, and there's a good chance that the market will start heading upwards. Anything above this line here, the 80 line, is considered overbought, and there's a good chance that the market may start to head downwards. What you're also looking for is for this main line to be across the signal line. So if the main line is below the signal line, it means that the market is going downwards, and if the line is above the signal line, it means that the market is going upwards. A crossover of these two lines usually means a change of direction. The most important area to look for a crossover is in the overbought or the oversold zones. So we've got our cross here, our golden cross. Let's just mark it off there. Now let's mark off the crossovers of the stochastics in or around the oversold areas, because we're going to be looking to take entries into this trend, rough trend, let's say, when there's a crossover in the oversold. So we have one there. Okay, is that a good trade? Yes, 50 plus pips. You could have placed your stop loss below the short-term moving average. I mean, the 50 period is not exactly short. However, for this trade, it would have given us a real tight stop loss, anywhere from 5 to 10 pips, which provided a good risk to reward ratio on this particular trade. Okay. You can also use the stochastic to exit. So you could exit when it's overbought and crossing down in the opposite direction here. However, there will often be times where the market continues to move upwards, even though there is a crossover in the overbought zone. But we're looking to take long trades. As I said, this is a golden cross. Price is above the moving averages. The short term is above the long term. Okay, so let's look. That's one entry there. Stochastic crossover here. This is a even better entry because there's a bigger pullback. Oversold zone. Main line crosses the signal line. Price above the moving average. We have the golden cross still in play. And this is another good trade that went over 100 pips. You could have put your stop loss just below the longer term moving average, even below this area of support here, roughly around here. Either way, it would have been a relatively tight stop loss, giving you a good risk to reward ratio on this particular trade. And of course, if the market didn't go up in this direction and continued going down, you would have been taken out for a small loss. But if you were taking this previous trade, you would still have been up. Okay, so that's the second entry. Let's have a look for there's one here. Okay. See, we can look at the divergence on the stochastic here, maybe suggesting that the market is consolidating, even perhaps starting to may go in a downwards trajectory, because we have the lower lows here. As you can see, when you have the higher highs, higher lows here, the market is moving more of an upwards direction, but we'll cover divergence in another video. So let's go back to that entry with the crossover here. Crossover, oversold zone, golden cross, another good move. Very similar to the previous one, but had you missed that, you could have entered here, because there is a level of support. Or if you wanted further confirmation, you could have waited for price to close above the MA, moving average, and again another trade for 100 plus pips. Stop loss again below the support level. You could even use this support here that we would have used on the previous trade. It's still going to be 10 to 20 pips, a decent stop loss level. Okay, so you can see 1, 2, 3 good opportunities to enter on this golden cross. You don't necessarily need to take them all. You know, some of you may have taken this one and tried to stay in the trade. There's nothing wrong with that. However, you would have got taken out here, which is why it would have been a good idea to trail your stop loss on the other side of the moving average here. As price moved up, you could have put your stop loss along here, and then you would have been taken out here still with some profit and had the opportunity to re-enter around here. Otherwise, you might have looked at resistance. Here is a resistance level. Price didn't go above here. So had you had entered here and you seen price rejecting this level, you might have considered exiting the trade around here and taking profit. either way, there was ample opportunity to exit the trade. As I said earlier, the crossover, the stochastic here in the overbought area was another opportunity you could have used to exit. But then there are times when that will give you a premature exit, such as this one here. If you see it crosses over, had you exited there, you would have missed a good run up there. However, there was another cross, albeit not oversold, in this pullback area here. So you could have got back in the trade. I mean, you would be paying more in broker fees in terms of spreads, commissions, but there's other indicators you could have used to enter in this area. I mean, even that bar there suggests there was going to be a big move upwards. So where were we? Okay. Crossover, overbought, crossover, mainline and signalized stochastic, golden cross still in play, although if you look back at this, you might not want it to continue trading it because it's looking a little choppy. You could obviously go down to the lower chart time frames to see what the price action was doing there. But let's say you did go for this one. Crossover, oversold zone, stop loss. I mean, probably below this bar. Could be considered support even further back here. I mean, the stop loss would have been 20 odd pips. I mean, when you consider that the resistance level up here is 60 odd pips away, there's still plenty of room for a decent 3-to-1 risk to reward ratio. Okay, so say you take that trade. Okay, you can stay in there till you hit your risk to reward ratio. You can exit on the stochastic cross there. You can just watch the price action and see as it starts to bounce off this level of resistance again around here. May have been a sign, okay, definitely here after you've seen what happened there and there, would have been a sign to exit. Okay. Of course, you can draw your support lines as well on the lows. Okay, you can see price bouncing off this line. Okay, and then here's when we have a break below that line of support. You see the moving averages are heading in the downwards direction. We have the death cross here, which is the opposite of the golden cross, 50 crossing below the 200, which suggests bearish momentum. We can also draw divergence here. Lower highs, showing that, okay, maybe this trend, if you can call it that, is exhausting. So probably we definitely wouldn't be taking that one. And this probably would have been the last safe opportunity, I'd say. You could look at these crossovers, but they're not in the oversold zone, and also you can see that you're higher up here. It's better to enter on a pullback, buy low, sell high. Okay, anyway, as you can see, there is ample opportunity to catch time entries into this golden cross with the stochastic. You can use other indicators to time your entry. You can also use price action, pin bars, etc. Support, resistance. Let's go back. Okay, let's have a look at this. Well, this is a nice one. I mean, if you just wanted to do it as simple as possible and enter on the cross and exit on that cross, it would have been a good move. But more often than not, you'll see a scenario play out like this one, where you'll end up at break even or worse if you don't try and time your entry and exit. Okay, so we can apply the stochastic. So we have the golden cross there, 50 moving average crossing above the 200 moving average. 1 hour euro dollar chart. You do have a crossover of the stochastic here. However, price is way away from the moving averages. So you want to wait for a pullback. So you don't buy on the high. So a nice pullback to this area and this area here. Okay. You could have taken that cross there. In this instance, your stop loss would have been down here somewhere, which is 50 pips, which is quite a lot. Not terribly bad for the 1 hour charts, especially when you consider how far this move went. However, had you waited patiently, price came down even further, and you could have entered around here on this cross. So across here, here. I mean, there's ample maybe not this one, because again, price is further away. But if you wait for a pullback between the two MAs and a crossover in the oversold area here, I mean, still a big move there. You can already see that the trend's developed. You still have a relatively tight stop loss, just 25 pips below the moving average. I mean, a nice pullback here. Could have catched the end of the move up. Okay. And what you can do as well is you don't have to use the stochastic oscillator. It can help, avoid entering if it's showing signs of being overbought and timing your entry or your exit in these oversold and overbought areas. But you can just use basic support and resistance levels, breakouts, to time your entry as well. I mean, you can see this level of resistance here eventually became support here. Price is further away from the MAs, but you've got a decent level of resistance come support there, and price action signaling upwards movement. And also the stochastic is crossing over below the 50 middle line, so it would have been a reasonable trade. However, you would have been better off getting in somewhere down here. As you can see, there is ample opportunities to enter the golden cross using indicators, price action, support and resistance. Just make sure that you use sensible money management. The stop loss I like to put below the moving average or recent level of support when trading long, and a risk to reward ratio of at least 3-1. Trailing, using a trailing stop loss to lock in profits and avoid getting caught in a situation where the market does turn around. Okay, well, hopefully that's a good enough explanation of the golden cross for you. It's a very simple trading strategy. I hope you've enjoyed the video. Please like and subscribe for more. Thanks for watching.